All right, so welcome to today's webinar, How to Master Forex in 2017. Today we're going to be discussing how to master Forex in the new year. Now, if you could spend 6 months learning to become a trader or learning to become a profitable trader, or if you're already a profitable trader, becoming more profitable. If you could spend the first 6 months of 2017 becoming profitable or becoming more profitable, and then the next 6 months, the final 6 months of 2017, you can spend actually making money, would that be good? Yes, 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 awesome, yes, yes. Of course it would. I mean, it's a bit of a, I don't know, it's a bit of a rhetorical question, I guess you would say. Of course it would be good. If you could spend 6 months learning to make money, and then the other 6 months actually making money, that would be great. But in those first 6 months, you're probably not going to make money. That's probably the trade-off you have to make. Now, you could also trade a live account for your first 6 months, but it's not the best, and we'll discuss why. But I want to teach you how to do that. This is what this webinar is about. I want to teach you how to do that. I want to teach you how to start fresh in 2017. If you've already been trading, I want to teach you how to start fresh. If you've not traded yet, I want to teach you how to properly start trading. I want to teach you how to start properly in 2017, and by the end of that year, by the end of next year, I want you to be a profitable trader. And to do this, I'm going to give you a plan to become a profitable trader. I'm going to give you a 5-step plan. It's 5 steps to follow to essentially become a great trader. Now, I'm not going to promise that you'll become a great trader by the end of next year, because becoming a great trader, a truly great trader, takes a lot of time. But I want to get you started on that journey with these 5 steps. They're 5 pretty simple steps, but they're deceptively simple because it does take a lot of work to get through them, and it takes 6 months minimum to get through them. So that's what I'm talking about when I say you got to commit 6 months. And at the end of that 6 months, you will be a better trader. And that's a promise that I can make to you. It's a guarantee that if you invest 6 months of your time, you will become a better trader. I'm not saying 100% for sure you will become a profitable trader. I'm not guaranteeing that. So please don't hold me to that. Don't come to me in 6 months and say, hey, look, I'm not profitable. You lied to me. I'm not talking about becoming a profitable trader. I'm talking about becoming a better trader. You know, the profit might come after that, or it might come in those first 6 months. You know, that depends on the individual, but I want you to invest 6 months next year, your first 6 months, to become a better trader. And I guarantee you that if you follow these 5 steps, you will. So essentially, I'm going to be teaching you in this webinar what you need in order to trade successfully by midway through next year. Does that sound good? Too good. Yeah, I kind of agree. It does sound too good. The thing you need to know about me is I don't hype things up. So I guess that did sound a little hypey, but there is going to be some reality injected in over the course of this webinar. There are several things you have to do in order to progress through this. And it's not going to be super easy. You need to commit, and there are going to be tough periods, and you need to get through those. So there is a lot of reality. It's not easy. It's not going to be easy. The steps are simple, but following those steps is the hard part, and that's where most people fail, because they can't follow the steps, and they can't think about it logically, and they can't get through it. But we're going to talk about the steps anyway. First, I just want to tell you guys a little about myself, just because there's a lot of people here who don't know me, who don't know who I am. So I'm just going to briefly tell you a little bit about my story, how I started trading. That way you guys know who I am and know that I know what I'm talking about. So I'm Nick Bencino. I started trading at the age of 16 in 2003. I started in school, actually. When I was in school, it was my economics class. We had a competition called the stock market game. This is something that happens in Australian schools. I don't know if it still happens, but it used to happen back when I was in school in Australia. So this was 2003. We had this competition called the stock market game. Essentially, we were all given a stock market trading account with 50,000 in it. Obviously, 50,000 demo money, not real money, because who's going to give kids 50,000 real money? So we given 50,000 demo money, and we were told to trade. And that's what I did. You know, I started trading. I started trading the Aussie stock market, and I read up papers. I honestly think I just got lucky, because I didn't really know much about trading at the time, but it went really, really well for me. And I ended up winning. I won the competition and I did really, really well. So I convinced my dad to open up a trading account for me. Now, you know, I was still 16, so technically speaking, it wasn't really legal for me to be trading, but my dad was a good sport and he opened up a trading account for me. Over the next few years, I started trading live. I started trading live in school. So I was still in school and I was trading, and I made a lot of money. I mean, a lot of money. I turned what I started with into a lot. I'm not going to talk about how much money, but I made a lot of money. For someone in school, it was crazy. But it didn't last. Around about when I was finishing school, my last year of school, towards the end of it, I lost pretty much everything I made. I lost everything. Now, that was a pretty tough lesson for me, and I stopped trading for almost a whole year after that. But it kind of taught me something, all of that. You know, starting with something small, making a lot of money, it taught me a lot about trading. After a year away from trading, I was, I don't know, 18 and a half, something like that. I started trading again. And this time I started doing things differently. I looked at the charts and I started to notice these patterns that kept repeating themselves. And at the time I didn't realize, but what I was looking at was price action. I was looking at support resistance. I was looking at candlestick analysis. But, you know, I didn't have names for it because I didn't have books to study. I didn't have anything like that. I was just looking and learning from the charts. And slowly, I started to become a profitable trader. It took quite some time. It took a few years, but that time was time well spent. I became a profitable trader, and now I'm where I'm at today. A consistently profitable trader who makes the bulk of my income on Forex. And I am also looking to expand to other markets. I'm looking to start trading futures. So, anyway, what I learned from my struggles when I was a kid, learning to trade, making a lot of money, blowing it all. I'm gonna stop reading the chat because it's kind of distracting. Like I read the chat and then I get distracted, so I'm gonna stop reading the chat. So anyway, what I learned from basically teaching myself to trade is that there are three core skills that you need as a trader. 3 core skills. They are important skills that you need to master as a trader. It took me years to master all of these skills. Now, I don't think that it takes everyone years to master them because I did it on my own. But you guys, you have help. You have me here. You have other people online. You have each other to learn from. Everyone in this room, you can make friends with each other and you could learn from each other. You can work on it together. I learned there were 3 core skills to trading. 3 very, very important skills. And without those skills, you cannot become a profitable trader. Maybe if you master 2 of those skills, you can be profitable, but you're not going to be a truly great trader until you master all 3 of these skills. So what are these skills? Oh, there we go. I couldn't change the slide right away. So what are these skills? Okay, so skill number 1 is your trading strategy. Having a good trading strategy and being able to use it. That is skill number 1. Right? I mean, that makes sense, right? Having a good trading strategy. You need a good trading strategy to actually trade. That makes sense, right? Say yes or say no if you disagree. All right, cool. I'm getting yeses. Not seeing a no yet, so We can assume that you guys agree. You need a good trading strategy to trade. That's one of the core skills, and you need to be able to trade that strategy properly. Now, in today's webinar, I want to discuss trading strategy. I'm going to discuss my trading strategy towards the end. Hopefully, we have enough time to fit that in, actually. But otherwise, I'll link you guys to some other webinars in which I discuss my trading strategy in detail. The next skill is risk management. Risk management is very, very, very important. Risk management is, I don't know, technically, it is more important than your trading strategy. I know risk management doesn't sound sexy. You know, the words risk management, it sounds kind of boring. Kind of like, do I really need to do that? But yeah, you do. You do. It is more important than your trading strategy. You can have the best trading strategy in the world, but no trading strategy is going to make you right 100% of the time. There's no trading strategy that could make you right 100% of the time. Not being able to manage your losses, not being able to properly manage your wins, not being able to decide how much you should risk per trade, not being able to decide any of these things is going to hurt you in the long run. It's going to be very hard to be profitable without proper risk management. So that's the second core skill of trading, risk management. So we have the trading strategy, we have the risk management. Then we have trading psychology. Now, trading psychology, again, is one of those things that doesn't sound sexy, does it? Trading psychology. Why do you need it? But if you've been trading, you know that you need trading psychology, right? You guys, the people here who have actually been trading, you know deep down inside that you need to master your trading psychology, because if you don't, you're going to get scared and get out of trades too quick. You're just going to make so many mistakes. Trading psychology is vital. Now, what do you guys think is the most important of these three core skills? The most important. All of them: risk management, psychology, risk. I'm glad most of you aren't saying strategy. That's very, very good. Most people automatically say strategy, but strategy is not the most important. I mean, strategy is important, but it is not the most important. For me personally, I think that it's a tie between risk management and trading psychology. I think that if you even have a strategy that is right 40% of the time, so if you have a pretty bad trading strategy that only wins trades 40% of the time, you could theoretically make it work if you have the right trading psychology and the right risk management. Now, ideally, you do not want that. My trading strategy is right with a newbie trader, a new trader, a trader who has no idea what they're doing. If they follow my trading strategy, they should be right 60% of the time. An experienced trader like me, I could probably do, well, it depends on the year. Last year was kind of like 67 point something. I can't remember the exact number, but I was right a fair bit. But you can have a strategy that's right only 40% of the time and still be profitable if you master risk management and trading psychology. Those two are the most important things. Because someone's saying right now, Charlie's saying, without psychology, your risk management will not be good. And that is completely correct. Without psychology, your risk management will not be good. And without proper risk management, your trading psychology probably won't be good, because you're going to be losing a lot more than you should be losing. And that is going to affect your trading psychology. So trading psychology and risk management are vital. And with these 5 steps that I'm going to talk about in this webinar, I want to teach you how to master all of these things. Now, I can't promise you that you're going to master them within 6 months, but I want to get you started on the path to mastering those. That's what I want to do. So I'm going to talk about these 5 steps in this webinar. And first, I want you guys to make me a promise. I'm going to share this with you guys, and it's very, very powerful, and it's very, very important that you guys actually do this, right? So I want you guys to promise me that you are going to commit to following these steps. Now, by promising me this, you're not committing to anything other than you are going to follow these steps. If you actually set your mind to it, it is not that hard to do. It could take 6 months, but it could also take less than 6 months. It could take 3 months. It just depends on how often you are trading. All right. Looks like most people have said yes, so that is good. All right, so let's get started. Let me tell you the steps that you need to take in order to master trading in 2017. I'm going to start with step 1, and that's pick a strategy. Now, this one sounds pretty simple, and obviously I am going to suggest my trading strategy because it's the only strategy that I actually trade. So it's the only one that I can suggest in good conscience. I can't really suggest something that I haven't tried. So first step is to pick a strategy. Now, when I say pick a strategy, I just mean pick a trading strategy. It does not have to be mine. You could pick a strategy that works better for you. But like I said, obviously I'm going to suggest mine because I know it works, and I've got a lot of students who can attest to it working. I feel that price action is pretty much the best way to trade. The reason for that is that price action requires no indicators. So you guys know what a chart full of indicators looks like, I'm assuming, right? If not, let me show you, actually. You guys can see this chart, yeah? You should be able to, right? This is my chart. Now, my chart looks a little different to what it normally looks like. Normally, I have shaded areas around my lines, but this is my chart. Nice, clean, simple chart. Not much clutter on it. This is how I trade. This is all I need on my chart to actually take successful trades. This is price action. This is price action trading. Now, a lot of people, they add a lot of indicators to their charts. Normally there's a lot of SMAs on a chart. Bollinger Bands is something that a lot of people use. MACD, do people still use that one? Give me another indicator, guys. Another indicator that people use. Stochastics, that's a good one, yeah. Oh yeah, the RSI. I remember the RSI too. All right. So you guys have probably seen a Forex chart like this one, right? I mean, maybe one less indicator, but you look around the internet, this is pretty common. Even worse than this. I mean, I've seen some charts that should come with an epilepsy warning because of all the colors and all the indicators on there. I mean, there are some crazy charts out there. Now, does this look very easy to trade, very comfortable to trade? Not to me. Definitely not to me. I don't like this. I hate this. I trade with just price action. So I read the candles, I see what the candles tell me, and I look at support resistance. Support resistance is just basically floors and ceilings. That's what support resistance is. Support resistance is a floor and a ceiling. Wherever price is right now, so price is here right now, there's a ceiling above it, here, and there's a floor below it, here. The floor prevents price from moving down, the ceiling prevents price from moving up. We can see several bounces there. So this has acted as a ceiling 3 times. We can see support here. This has acted as a floor 4 times. Now, there are a lot of videos of mine in which I teach you how to play support resistance. I want to teach you also in this webinar, but I want to get through the 5 steps first, and then we'll talk about placing support resistance. So please just wait on how we actually place them. I'll talk about that later. But essentially, price action is price action is one of the best ways to trade, because like Marion is pointing out right now, what indicators are just old price action. When you have an indicator on your chart, what it is doing, it's taking price action, it's putting it through a mathematical formula, and then it's spitting the results onto your chart as a pretty little line or bars or whatever. That's all indicators are. Indicators are price action put through a mathematical formula and then placed onto your chart. I rather go to the source. I'd rather look at price action, and without indicators, without the middlemen that indicators essentially are, I'd rather just take trades based on the price action. And the only tool that I use beyond that is support and resistance, because support and resistance allows you to pick turning points. Now, I mainly trade reversals. That is my bread and butter, reversal trading. If you look on my YouTube, you'll see a lot of live trade videos of me trading reversals. I don't only post profitable trades, I also post my failed trades. When I start recording a live trade video, I have a policy that I post it regardless of whether it's a good trade or a bad trade. So if you go look at my live trade videos on YouTube, you'll see me actually taking trades. There's a very recent one actually that was taken towards the end of November. Now, the point I'm trying to make is price action is consistently, for me, the best way to trade, because price action has several advantages. It adapts to changing market conditions. Market conditions are constantly changing. If you go back to 2014, you'll see massive low volatility. So there was a huge low volatility period in 2014. Now we're seeing volatility starting to ramp up again in 2015 and towards the end of 2016. So market conditions are constantly changing. Price action adapts to changing market conditions, whereas indicator strategies do not adapt as well. So when I say step one, pick a strategy, what I am saying to you is that you should focus on price action. That is my personal advice based on my 16 years of trading. Focus on price action. Price action is, in my opinion, the best way to trade. Next is you should focus on higher time frames. Now the reason for this, and it's a very simple reason, the reason for this is that lower time frames are harder to trade. I'm not saying lower time frames are not profitable. You can be profitable trading lower time frames. You can definitely be profitable. I know profitable traders who are trading lower time frames. I trade lower time frames sometimes with price action, and I am profitable. Does that mean you will be profitable if you are new to trading? And it doesn't. You probably won't be. Lower time frames are very stressful. You are going to take more losses because that's just the nature of trading lower time frames. You are going to take more losses because they are less predictable. So, as a new trader, do you think it's a smart decision to trade a time frame that's going to be stressful and that's going to give you more losses? No. Yeah, well, I'm getting a lot of no's. I mean, obviously the answer here is no. If you're a new trader, it doesn't make sense to trade something that's going to be high stress and that's going to produce more losses. Why? Because of your trading psychology. The more losses you take, the harder it's going to be to keep on trading and to make smart decisions, because it's going to impact your trading psychology. The higher stress trading becomes, the harder it's going to be to make good trading decisions, the harder it's going to be to do anything in your trading. It is very, very important that you try to make your trading as low stress as possible and that you try to make it as easy on yourself as possible while you're learning. When you get good enough, sure, you can start experimenting with lower time frames. That is fine. That is okay. But when you're learning, you want to stick to higher time frames because it's less stress. Okay? Less stress is good, right? Less stress is good. We all need less stress in our lives. I mean, who doesn't? Less stress is a good thing. So higher time frames, please, please don't get tempted by lower time frames. Don't get tempted by the fact that lower time frames have smaller stop losses, therefore require a little bit less capital. You shouldn't really be worried about capital right now. Your first 6 months, you are learning to trade. You are not worried about making money, you are learning to trade. So who cares about capital? Who cares about larger stop losses? Not important. What's important is that you learn to trade successfully. And to do that, you use higher timeframes because they are easier to learn. When you are a confident, successful trader, you can switch down to lower timeframes and you can play around with them as much as you want, because then you're coming to lower timeframe trading from a place of experience and a place of confidence. But approaching lower timeframes, and when I say lower timeframes, I mean anything below the 1 hour chart. When you approach them from the point of being a new trader, inexperienced, not having good trading psychology, not having good money management, risk management, then you are setting yourself up to fail. That's just it. So higher timeframes, please. When you pick a strategy, I suggest going with price action, but I don't only suggest going with higher timeframes, I implore you to go with higher timeframes. It is beyond vital. Now next is low maintenance. What do I mean by low maintenance? Well, my strategy is low maintenance. Low maintenance trading is, I think, the best approach to trading. The reason I say low maintenance trading is good, there's a quick question here and I'll answer it. The 4 hour and higher, yeah, that's generally what I suggest. I mean, you can trade the hourly charts if you want, but generally speaking, I stick to the 4 hour or higher. But the 1 hour is fine for price action trading. If you want something lower than the 4 hour, go for the 1 hour, that's fine. But yeah, try to stick to the 4 hour and above if you can manage it. There'll be plenty of trades on the 4 hour and above, trust me. You don't really even need the lower time frames. So, low maintenance trading. Low maintenance trading is good if you're busy. Now, I'm sure most of you are busy. You don't have 8 hours a day you can dedicate to trading. Would I be correct in saying that? So you want to fit trading around your schedule, I'm assuming. You don't have to say yes to this one. I mean, obviously, if you're busy, you want to fit trading around your schedule. That's why you need low maintenance trading. Now, low maintenance trading is essentially trading. Okay, I know some of you are retired, so you do have time. But even if you are retired, you still don't want to spend 8 hours a day in front of your computer. You want to spend your time doing something you like, presumably. And if not, if you want to spend 8 hours a day in front of your computer, awesome. You can still trade price action and you can still trade on higher time frames. You could just take more trades than most other people are taking. So low maintenance trading is essentially trading with only a few hours per week. Now, I want to make something very clear from the start. Because most of you here are learning to trade, you are not going to be able to trade successfully with a few hours per week. While you're learning, you need to dedicate more time to it. You do. It's just a fact. You're not going to be able to trade just a few hours per week while you're learning. But after you learn, after you become a successful trader, after you're consistently profitable, you can start to limit your time trading and still take awesome trades if you do it properly. Now, we'll discuss how to do it properly. We'll discuss my strategy hopefully later in this webinar, but I'm not sure if we're going to have the time. But even if we don't discuss it in this webinar, I'll link you guys to webinars in which I discuss my trading strategy in vast detail. So you'll be fine with that. So step one of this 5-step approach to trading in the new year, step one is to pick a trading strategy. Pick a price action strategy. I suggest my price action strategy. Focus on higher time frames and try to keep your trading low maintenance. Try not to focus on your charts too much. The reason you want to do this is because when you spend too much time staring at your charts, you're going to burn yourself out pretty quickly. You're going to start making mistakes. Has anyone ever heard of paralysis by analysis? Yeah? Paralysis by analysis essentially means that you spend so much time analyzing, you spend so much time looking at your charts, looking at the trades, trying to figure out what the best trade to enter is, that by the time you're actually about to enter, you're too afraid to enter. So I like to take a low maintenance approach to trading. I like to do my analysis a few times per day, which takes a total of about 30 minutes in a day. If I spot a trade, I like to take that trade, but the way I usually do my trades these days is I set an entry, a target and a stop loss. After I enter the trade, I don't really look at it anymore. I put my phone back in my pocket. Most of my trading these days I do from my phone. So what I'll do is I'll take a trade, set an entry, stop loss, target, put my phone back in my pocket. I was in Paris. Wait, was it January or was it December? I can't remember exactly, but I was in Paris last year or at the start of this year. And me and my girlfriend were walking around. We were checking out Paris. I check out my phone. I look at my trades. Sorry, not my trades. I look at my charts. I do my analysis. I see a potential trade pop up. And I say, okay, that's a pretty good trade. I set an entry. I set a target. I set a stop loss. Put my phone back in my pocket. Then we keep walking around. We're looking at Paris. We're just enjoying Paris. It's a beautiful city. So we kind of got wrapped up in what we were doing. And I forgot about the trade. I completely forgot about it. The next day, I was so wrapped up in being in Paris, and to be honest, my girlfriend was a little annoyed that I had been looking at my phone for the first few days, looking at trades. She was like, can't we just enjoy our vacation? So, I didn't even think to look at my phone anymore. I didn't look at my charts. Next day after that, I still didn't look at my charts. I think it was that evening. That was like, 48 hours or more after I took the trade. I finally looked at my phone again and I look at the trade and it had closed out successfully. So while I was walking around Paris, enjoying my time, I entered a trade and without anything further, that trade closed out successfully. Now, I'm not saying this to brag. What I'm saying is this is low maintenance trading, right? This is what low maintenance trading is. You enter your trades and you don't focus on them. You don't just stare at them all day. You enter your trades, put your phone back in your pocket, and you go on about your day. And that's why I like low maintenance trading, because you could fit it around your schedule. If you're busy, if you got a lot of work, if you got kids, you can't spend hours per day staring at your charts. One, it's going to stress you out. And two, it's just not something that you can afford to do. So low maintenance trading is the best approach to trading. So pick a trading strategy, pick a price action strategy, focus on higher timeframes, and focus on low maintenance trading while you're learning. Now, while you're learning, like I said, you're not going to be able to only do 30 minutes per week or 45 minutes or 1 hour per week or whatever. That's not possible while you're learning. While you're learning, it's going to take more time than that. But you can still do low maintenance trading while you're learning. Now, like I said, my strategy fits all of this criteria. So we are going to be talking about my strategy towards the end of this webinar, or I'll be linking you guys to a lot more detailed webinars about my strategy. So, number 2, define your risk. Right? This is step 2. You need to define your risk. Now, when I say define your risk, what do I mean? Every trade you take, you need to have a set risk before you enter that trade. That is risk management 101. It is the most basic rule of risk management. You can't risk 5% on one trade, 2% on the other trade, 0.1% on the other trade. You can't risk just random amounts, whatever you feel like it at the time. You need to set your maximum risk per trade before you take the trade. Or you can also just set it now. Now, for the first 6 months of next year, now you guys have promised me that for the first 6 months of next year, you are going to follow these steps. What I want you to do is I want you to set your risk at 1%. 1% per trade, right? So if your account size is 10,000, let's say just theoretically, just because it's a nice round number, not because you need 10,000, but let's say your account size is 10,000, what is your risk going to be? 100, exactly. Per trade, you are going to be risking $100. If your account is $10,000, $100. Set your risk to 1% per trade. Now, I know a lot of people are saying that's hard to do. What if you start with a smaller account? We'll get to that. Don't worry about that. Set your risk to 1% per trade. That is important. It is vital. That is how you succeed in trading. Because you have to trade for the long term. You don't have to trade for the short term. It's not about turning your $500 into $10,000 by the end of the year, because that's not going to happen. It's unrealistic. It's not possible. It's just not going to happen. Well, wait, sorry. Technically, it is possible if you take massive risk, but that risk at some point is going to turn around and it's going to bite you. That's what happened to me when I first started trading. I turned a small amount of money into a lot of money when I was in school. I turned a small amount into a lot, but I lost it all because I was risking way too much. You can't risk too much. You need to set your risk to 1% per trade. It is important. Now, step 2, define your risk. Set your risk to 1% per trade. Your risk is going to change. At the end of this 6 months, you can change your risk. I suggest you don't go above 1%. When I say change your risk, it's probably going to be a bit lower than that. Some people say they're comfortable with 2%. I disagree, but hey, if you really want to stick with 2%, just make it your maximum. You need to set a maximum risk per trade. So I suggest 1% while you're learning. So while you're learning, do 1%. 1% per trade, that is your risk. Some people here are saying 0.5%. Sure, if you want to do 0.5% because you're scared, go for it. That is fine. 1%, this number here, this 1% is your maximum risk per trade. That is your maximum. You can go lower than that. You can go lower if you want. 1% is your maximum risk per trade. 0.5% is fine. But yeah, 1%, set your maximum risk per trade to 1%. The reason you want to do this is because trading is for the long term. What is trading? Trading is for the long term. We're not talking about making 10,000 by the end of 2017. What I want you to do as a trader, and how I want you to think about trading, is that over the next 5 years, over the next 10 years, you are going to be making your living trading Forex. So you need to build up slowly. You need to add money to your account slowly. You need to build up your account slowly. If you start taking big risks, if you're risking 5% per trade, what do you think is going to happen? Now, I'm going to show you guys a tool that is inside. One sec, I just need to bring this tool up real quick. I was supposed to have it already open, but I kind of forgot. So give me a second. All right, so I'm going to show you guys this tool. This tool is our part. For anyone who wants to access it, you can't access this tool on the website. It's part of the Forex Mastermind section. It's a private section of Forex for Noobs. But I'm just showing you guys this tool to explain something. Yeah, Davor, you've kind of hit the nail on the head. Davor is saying right now, let me bring this onto the screen for people watching this as a recording. I started the year with 5%, but then 13 losses in a row started to happen, and luckily I reduced to 1% on time. That is exactly what I'm going to be talking about right now. So what I want you to focus on next year, at the start of next year, I want you to build, like Charlie is saying, I want you to build a foundation. I want you to grow your money, and I want you to grow your skill, and I want you to become a better trader. It's going to take time, but you've already promised me that you are ready to invest that time. So I'm not sure if I can zoom in. I guess I could do this, but yeah. All right, so why am I showing you this calculator? I want to show you this because it shows you something very important about trading. Now, as a new trader, what percentage of your trades do you think you can win, realistically speaking? 40%, someone saying? Adam? 50, Eric? 50, 50, 55, 50. All right, you guys have got a good idea. Not a good idea, but you guys are thinking about this in the right way, right? 50% as a new trader is pretty realistic, maybe even 40%. That's realistic. And Ash is saying it depends on risk reward. It also depends on risk reward. But I'm just saying, trading the way you are now as a new trader, 50% is around about what you should be winning. Now, I know that doesn't sound incredibly sexy, 50% of your trades, you're losing 50% of your trades, but it is realistic. Because you're new to trading, it's going to be hard to get much above 50% strike rate. So with a 50% strike rate, over the course of 1,000 trades, this is a losing streak calculator. This tells you what losing streak you should expect over the course of 1,000 trades if you have a 50% win rate, right? Look at what it says here. It says 10 losing trades in a row. Now this is just mathematics. This is just the mathematics of probability. With a 50% win rate, you are at some point in your first 1,000 trades going to experience 10 losses in a row. That is not, this is just probability. If you were to flip a coin 1,000 times, over the course of 1,000 flips, you are probably going to hit 10 of the same in a row, or you're probably going to guess it wrong 10 times in a row. That's just how it works. It's just mathematics, right? Now think about what that means for your trading. If you're risking 5% per trade, how much of your account is going to be gone after those 10 losses? Half your account, essentially. Not exactly, but a major portion of your account is going to be gone. Because if you're risking 5% per trade, it won't be 50% because you're risking 5% of your balance. So as your balance drops, it's 5% of that new balance. So it won't exactly be 50%, but it's going to be a major portion of your account. Risking 5% per trade, 10 trades in a row lost. Bye-bye account. Who wants that? Do you want that? Does anyone here want to lose that much? No, not really. Of course you don't. But that's the reality of trading. If you're risking too much, you are going to hit that losing streak at some point. It's just going to happen. You're going to lose a big portion of your account, 40%, 50%, it's going to be gone. And you know how long it takes to get your account back up to where it was when you are down 50%? Do you know how long that's going to take? It's going to take a long time. You don't want that. You don't want that. So that is why you set your maximum risk per trade to 1%. And I know some of you are going to say, but I only have a $300 account, so 1%, I can't do that. Well, you know, that just means that you need more money in your account. That's all it means. You need more money in your account. The solution is more money, not more risk. If you really think about it, that makes sense, right? The solution is more money, not more risk. Because more risk means you're just going to lose what money you have. Solution is more money. And what do I mean by more money? I know traders. I know one trader in particular. I'm not sure if he's here tonight. He's one of my students who essentially, he realized this early on. He needed more money in his account. So what did he do? He sacrificed. He sacrificed on things in his life in order to put more money into his trading account. So he cut back on expenses, and instead of spending money on coffee at Starbucks or whatever, he started putting that money into his Forex account. So he wasn't growing his trading account only by trading, he was growing it by putting money in each week. That is a solution. Whatever you can afford to put in, you start putting in slowly. This is after your first 6 months. But anyway, we're getting a bit off track and we're already running low on time, and we're only at step 2. So my point is, set your risk to 1% per trade, because you are going to hit a losing streak at some point. And if you're risking 5% per trade, bye-bye to your account. It's going to take you a long time to build that thing back up. It's not something you want to do. Set your risk to 1% per trade. If your risk is 1% per trade, you lose 10 trades in a row. You've lost less than 10% of your account. Building it up again is a lot simpler. And it's a lot less stressful. It is just a lot better for you. And yeah, that's because you are trading for the long term. You aren't trading for the short term. Who cares how much money you make next year? That is not important. What I want you to do is focus on 5 years from now being a successful trader, not making a quick buck next year, because that doesn't matter. If you make a lot of money next year trading by risking a lot, you're probably going to lose that the following year. So don't worry about that. Don't think about that. Think about the long term. The next few years, you want to be a successful trader. You want to make trading your living. Set your risk to 1% and trade smart. And what it all comes down to is risking smart, right? Write that down. I'm going to risk smart. And yeah, define your risk. The final thing that I quickly want to go through is target 1 to 2 on average. So target 1 to 2 average RR. What does that mean? Your risk to reward ratio on average should be, should be around about 1 to 2. So 1 to 2 risk reward ratio. That basically means your stop loss is 50 pips, your target is 100 pips. Now that is your average risk to reward ratio. You can go for a lower risk to reward ratio on a few trades. So you can go for 1 to 1.5, which would mean your stop loss is 50 pips, your target's 75 pips. That's fine if you want to do that on some trades where you think it makes sense to do that. But generally speaking, what you want to do is by the end of the year, average out to a risk to reward ratio of 1 to 2. So try to keep your average to this magical number here. 1 to 2 risk reward. If you risk 50 pips, you target, oh my God, why am I drawing this out? I shouldn't be doing this, but okay. You target 100 pips. That is a 1 to 2 risk reward ratio. That is what your risk reward ratio should average out to. So you are probably going to take some trades with a risk to reward ratio of 1 to 1.5. Then you are going to take some trades with a risk to reward ratio of 1 to 3. So it should average out to 1 to 2. Everyone clear on that? Are there any questions about that? Because I understand it's a little bit complicated when you've never really heard of risk reward ratios and all that stuff. Now the reason we do this with our risk to reward ratio, all right, some people are saying not clear. Essentially, what a risk to reward ratio is the ratio of your risk to your reward. So your reward on a trade is your target. Your reward on a trade could be whatever it is on that specific trade. I'm saying 100 pips because it's a nice round number. So if your reward on that trade, your target is 100 pips, your risk needs to be half of that, 50 pips on average. So let's say you take one trade. Let's say you went short here, right? Let me just zoom in and highlight this. Let's say you took a short trade here. Now, this line here represents your entry. This line here represents your stop loss. This one represents your target. So what you want to do is you want your stop loss to be half of what your target is. Now, if you're using TradingView, this platform that I'm using, it's pretty awesome. It allows you to visualize this very quickly. So here we have risk reward ratio of 2. That means our stop loss is half the size of our target. That's how you should trade. Your average stop loss should be half the size of your target by the end of the year. Imre is asking, do you fix your stop loss or push your target? Basically, the way I do it is I set an entry point. After I set my entry point, I set my stop loss. Then I set my target. If my target is not, if I can't get a target that is at least 1.5 RR, risk reward, I probably won't take the trade. So you set your stop loss and then your target comes after that. One sec, guys. Yeah, whatever. Anyway, I was just going to ban someone because they're trying to advertise in here. I mean, who does that? But I think he's already gone, so I can't ban him. Anyway, so risk reward ratio of 1 to 2. So let's quickly review. Step 1, you need to pick a trading strategy, right? Step 2, you need to define your risk. Set a risk to 1% per trade, trade for the long term, and do your average risk to reward ratio of 1 to 2. Step 3, get a demo account. Now, I saved this step to step 3 because I think most people here are going to be like, oh, really? Do I have to trade demo? Can't I trade live? No, you can't. Why can't you trade live? For the first 6 months of next year, I want you to trade with a demo account. Why is this better than trading with a live account? A demo account is going to allow you to learn risk management. With a live account, unless you have the ability to start with 5,000 or so, it's going to be very hard to learn proper risk management. Now, what do I mean by proper risk management? I mean that what we talked about in the last one, that 1% per trade, right? If you have an account that's like 500, you're not going to be able to risk 1% per trade. You aren't going to be able to. Sam is saying that he would rather trade with a £100 account than trade with a demo account. Now, I'll tell you why this is not a good idea. Because the most important thing in trading, or one of the most important core skills of trading, one of the most important skills of trading is risk management. If you're trading a £100 account, you cannot possibly learn risk management. You can't learn risk management with a live account at £100. No, you can't, not even with micro lots. There's going to be trades with where your stop loss is going to be 100 pips, 150 pips. So what are you going to do with those trades? When you get a trade that has a stop loss of 100, 150 pips, what are you going to do? If you have an account that is too small, you have to either skip that trade, which just means that you're missing out on a trade. You're missing out on the experience you're going to gain from taking that trade. Sorry, I'm just reading the chat real quick. Yeah, okay. Yeah, I knew people were gonna say this. With demo, you don't get the feeling of risking money, you're not motivated, and I do somewhat agree with that. I really do. I mean, it does make a lot of sense. But at the same time, risk management is something that you need to learn. You need to get a handle on it early. So trading with proper risk management is something that you can only do on a demo account unless you're starting off with a big amount of money, which you probably shouldn't be if you're just learning anyway. learning risk management is vital. So dedicating the first 3 months or the first 6 months of next year to trading with a demo account just so you can master risk management, what that's going to do for you is it's going to allow you to master one of the most important things of trading, risk management. Once you get that, once you understand risk management, you can start trading with real money at that point. Risk management is vital. It's important. Trading with a demo account allows you to learn risk management. Now, I'm going to talk a little about how to make a demo account feel more real, how to make it sting when you actually lose. I'm just reading the chat real quick. Okay. Yeah, sorry, I was just reading through. I'm a bit of a slow reader, so I was just reading through everything. Now, there is one possible exception to getting a demo account, and that's trading with a broker that allows very, very small lot sizes, and starting with about £500 or something. There are a few brokers out there that allow you to trade with an extremely small lot size. So that would be the only one I actually know of that's actually reliable is Oanda. Now, I'm not recommending this broker because I've not actually done much live trading with Oanda, and I do not like recommending brokers. I'm just saying that there is one possible exception to the get a demo account rule or step. It is to trade with a broker that provides tiny lot sizes. So if you are committed to starting with a live account and you really think you want to, but you only have a few £100 to start with, find a broker that allows you very small lot sizes. This will allow you to learn risk management. Learn risk management. It allows you to do that because you're still able to risk a small amount of your account. You're still able to risk a small amount, that 1%, but you have a broker that allows you to do that with a very small lot size. Guys, stop arguing in the chat. Come on. People are arguing what's better, demo or live. Stop arguing in the chat. Everyone has a different opinion on this, and that's completely understandable. Everyone wants to take a different approach, and that's cool. I mean, if you are committed to wanting to start with a live account because you think it's going to feel more real, I'm not disagreeing with that. A live account does feel more real. It just depends the approach you want to take. I personally suggest a demo account because it gives you a better experience of learning risk management. But you can also, like I said, start it with a live account as long as you're with a broker that has a very small lot size. The only broker I know of that does that is Oanda. I'm sure there are others out there. With brokers, just please, I'm not recommending brokers. I don't like recommending brokers to people. Just please make sure your broker is regulated in a country with good regulations. So a country like the UK, the US, Australia, just a country with strict regulations. Find a broker that has a small lot size and do what you think is best for you. I suggest demo account, but the important thing to note is that you start with an account in which you can learn risk management. So you can actually risk 1% per trade. And demo accounts allow you to trade without risk, but you can actually learn a lot. And demo trading is forgiving. So open up a demo account would be my advice, and it is what has worked for my students. Now, I've seen several successful traders start off with a demo account. They have learnt risk management, and now they are trading successfully. It's not the only way to do it, but I think it is the best way to do it, because learning risk management is vital, and you aren't going to be able to follow step 2 with most live accounts. Set your risk to 1% per trade. Most live accounts, you're not going to be able to follow that step. It's just not going to happen. Simply because it just isn't possible. There's only very few brokers that will allow you to do that with a small enough lot size. Okay, so step 4, set a trade goal. Now this is the most important part. Now this is the one I was building up to. This is the one I want to talk about. Step 4 is to set a trade goal. Now, what do I mean by a trade goal? I mean set a number of trades that you're going to take in the new year. Now, this is something that you need to write down. You should take 50 trades next year. That is your goal, 50 trades. Why do you want to take 50 trades? Right? Why do you want to take 50 trades? Can anyone guess? Tell me. Can I take more? I'm just talking about your first 6 months. No, it's not about over trading. Test your strategy. Some people are getting it right. To test your strategy, to avoid randomness. Someone's experience. Yeah, a lot of these are right. But what I want you guys to do, if you get nothing else from this webinar, is I want you to commit next year, when you start trading in January, is I want you to take your first 50 trades. Following those other steps, I want you to take your first 50 trades. So step 1, what was that? Pick a strategy. So I want you to pick a strategy, and I want you to take 50 trades with that strategy. If you lose 5 trades in a row, do not change your strategy. Do not change your risk. Do not change anything. You just keep trading until you hit that goal of 50 trades. That goal of 50 trades is going to take anywhere between 3 to 6 months, depending on how often you are trading. If you get it done in 3 months, that is fine. But you could take up to 6 months to do this. It might take you a little bit longer if you have no time to trade, but 50 trades should roughly take you 3 to 6 months. That is how that's how long it generally takes my students. Now, the reason we do this, and then we also journal every single trade. You have to make a journal of every single trade. Now, as a surprise bonus for you guys, I'm going to give you my trading journal, the one I use for each and every trade. So I want you to, now I'm not talking about my FX book. My FX book is not enough, not even close to enough. It's just not. My FX book is great for getting your entries and all that stuff. But a trading journal is something different. A trading journal is something completely different. Give me a quick second here, and I'm going to bring up my trading journal, but it's not loading for some reason. All right, here I got it. This is a sample trading journal. I'm going to be linking this to you guys. Now, this is not a fancy piece of software. It's not my FX book. It's nothing fancy. It has nothing to do with that. I'm not talking about writing down your entry point and your target and your stop loss and just stuff like that. I'm talking about keeping a very detailed trading journal in which you fill in every single little bit of information you can think of about each and every trade you take. This is going to take time. It is going to take your time. It's going to take commitment. But you are going to, well, sorry, I hope that you are going to do this. What I want you to do in the new year, when you start trading again next year, is I want you to take your first 50 trades and journal every single one of those trades. You want to journal every one of those trades. Now, I'm sure most of you can guess why you want to do this. Why you want to journal every... Actually, let me show you the journal in a bit more detail. So this journal allows you to keep detailed information about every single one of your trades. So the first little bit of information is quite simple: date, time, and day of the week. So that's when you're trading. The trading session also refers to what trading session it is. If it's the London session, yeah, I zoomed in. Refers to if it's the London session. I'm going to be giving you guys this. You guys will be having a link to this, okay? So you don't have to write all of these things down. Next, you're going to put down the pair, time frame, and the trade direction. Trade direction just means long or short. Next, you're going to write who is in control of price, buyers or sellers. That is something important. That is something you learn when you learn my strategy. I'll be linking you guys to some videos about my strategy, free videos. Then you write down, have you identified your stop loss? Have you identified your target? What are your requirements for exiting this trade? How will you manage your stop loss and target? How do you feel about this trade? This is an important one. How you feel about this trade, this is an emotional thing. But it is important because your emotions are important in your trading. What are your emotions? Your emotions are trading psychology, aren't they? Yeah, they are. I'm not even going to wait for you guys to say yes. It's obvious. Your emotions are your trading psychology. So having a trading journal, it's important to write down how you feel about the trade. And also, after that, how do you feel about this moment in general? At this moment in general. Now, these are two different questions. How do you feel about this trade? Generally, you would answer this with, I feel confident, I feel nervous, I feel unsure, whatever. So how do I feel about this trade is something that you answer specifically about that trade. How do you feel about taking that trade? How do I feel at this moment in general is something different. That's how you feel. Do you feel happy? Do you feel sad? Now, I know it seems like, why am I going to write this down? But there is a reason, and we'll get to the reason. You know, write this down, fill this out. Am I in the right frame of mind? Ooh, mind. Am I in the right frame of mind to enter a trade? That is a pretty straightforward question. Am I in the right frame of mind? If you answer no to that question, you probably shouldn't be entering the trade. Am I entering this trade on the right time frame? That is more to do with strategy. Entry, stop, and position size. Trade notes, that's just extra notes you want to add in. Trade stats, your entry, stops, targets, and your risk to reward ratio. And this is after the trade. You write down if you followed your plan, if you're happy with the results of the trade, could you have done anything better? Now, why do we note all this down? Why is this important? Why do we write all of that stuff down? Because when it comes to 3 months into the new year or 6 months, when you're getting to that point in the new year where you've taken your 50 trades, if you've journaled every single trade, you can put that information into an Excel spreadsheet. And you can find what is common between your losing trades and what is common between your winning trades. Now think about how useful that's going to be. If at the end of your first 50 trades, you are barely profitable, you are just breaking even, do you think it would be handy to know what you've been doing wrong? Yes, it helps a lot. Definitely, yes, of course, yes. It would be helpful. That is why you need to do this. You need to take your first 50 trades. You need to stick to your strategy. You can't, if you have 4 losses in a row and you're feeling down, you can't just give up and go to a new strategy. You need to stick to your strategy for 50 trades, minimum. Once you stick to your strategy for 50 trades and you journal every single trade, you're going to have a nice pool of data that you can comb through to figure out what you were doing right and do more of that, and what you were doing wrong and do less of that. Now, how can a trading journal help you figure out what you were doing right and what you were doing wrong? It's actually pretty simple. Now, one of my students, this is going back I don't know, I think it was the start of this year, February, something like that. He done his first 50 trades, right? And after his first 50 trades, he put all this information into an Excel spreadsheet, each and every trade, because he was good and he kept his trading journal and he wrote down everything. And he noticed a bit of a pattern. When he wrote into this question here, when he wrote the answer unsure about the trade is essentially what he was saying, it turned out that most of his losing trades, he was unsure about them when he got in. So he wasn't confident about the trade as he was getting in. Now this is a very simple pattern that he found, but it allowed him to improve his trading. Because what was happening there was his intuition was telling him something. He looked at it, he said, I'm not too sure, but I'm going to enter anyway. So he had doubt, and that doubt ended up in, more often than not, a losing trade. So he got something out of that. Now that is a simple thing that you can get out of a trading journal. There's way more complex things. This is going back a few years, but another one of my students found, by keeping a detailed trading journal, they found that if they traded JPY, a JPY pair at a specific time of day, which was in between the close of the New York session and the open of the Aussie session, most of those trades were failing. Now, it took more than 50 for him to figure this out. It took more than 50 for him to figure it out. It wasn't just 50 trades, but he kept that trading journal for 50 trades, for then 100 trades, and he noticed that pattern. And that pattern allowed him to cut out a bunch of losses. Doesn't that sound awesome? Marion says yes. Jack says yes. Of course it sounds awesome. That is what you need to do, right? That is what I want you to do in this new year. When you start trading again in January, I want you to set your goal to take your first 50 trades. Your first 50 trades with your trading strategy. Commit to that strategy. Stick to that strategy for 50 trades. Even if you lose 20 trades in a row, you stick to it. Because if you lose your first 20 trades, that is possible. It's unlikely. I mean, come on, very unlikely. But let's just say you do. You could win your next 30 trades. Just stick to your strategy. No matter how bad it gets, stick to your strategy. Keep trading. Because at the end of that journey, you are going to have a journal for your 50 trades, and you're going to be able to figure out where you went wrong and where you went right. This is one of the most important things in trading. Stick to your strategy, set a goal for your first 50 trades, and journal every single trade. Do not get lazy with your trading journal. Do not get lazy. Fill your trading journal in for every single trade. Charlie is saying the data from a well-kept journal is crucial to success. Yes, Charlie, I completely, oh, damn it. I completely agree. Marion, make screenshots of the setup and results. Sure, if you want to, if you have the time, include screenshots in your journal. That's even better. That will give you even better, because then you can see what the trade looked like. And then if you notice a pattern in what the trade looks like, then, you know, that's also helpful data. All right, so final step. This webinar has gone on a bit longer than I thought it would. The final step is to review and improve. Now, I've already kind of hinted at this step. After you take your first 50 trades in the new year, I want you to put that data into an Excel spreadsheet. I want you to see what you did right and see what you did wrong. So those 50 trades, like I said, it's going to take you 3 months. It might take you 6 months. It depends. But I want you to commit to taking those first 50 trades. After you take those first 50 trades, I I want you to put the data into an Excel spreadsheet, or during if you want to, because honestly, it gets a bit tedious when you have like a pile of 50 trading journals, and then you have to go put them all into Excel at once. It's better to kind of do it as you go. So yeah, those are the 5 steps, guys. Now let's very, very quickly review. Step 1, pick a strategy. So what you're going to do in the new year, you're going to pick a trading strategy. Once you have a trading strategy, what you are going to do is you're going to define your risk. Your risk should be 1% in my opinion, and you should target on average 1 to 2 risk to reward ratio. Step 3, get a demo account, and if you really want to, get a live account with a broker that provides a small lot size. That way you can properly do risk management. Step 4 is to set a trade goal of 50 trades. Step 5, is to review and improve.